Silver just got crushed, but stackers should be even more worried. Silver just got crushed again. Another brutal smash, another coordinated paper dump, another round of headlines telling you the rally is over, the bull market is dead, and you should sell your position before it gets worse. If you're holding physical silver right now, you're probably feeling one of two things. Either you're angry because you've seen this pattern before and you know it's manipulation, or you're scared because even though you believe in the fundamentals, watching your portfolio drop 15% in 48 hours hurts. But let me tell you something that most silver YouTubers won't tell you. Something that's going to make you uncomfortable. Something that might actually keep you awake tonight. The price crash is not what you should be worried about. The price will recover. It always does. The fundamentals haven't changed. The supply deficit is still there. The industrial demand is still there. The Eastern buying is still there. No, what you should be worried about, what should genuinely concern every single person holding physical silver right now, is something far more insidious that's happening quietly underneath the surface while everyone is distracted by the price action. And if you don't understand what I'm about to show you, you could lose access to your silver even though you think you own it. Ladies and gentlemen, Asianguy here. This is not clickbait. This is not fear porn. This is a warning based on patterns that are emerging across multiple jurisdictions simultaneously. Patterns that suggest the end game for physical precious metals holders may not be confiscation, may not be taxation, but something far more subtle and far more effective. By the end of this video, you will understand the real threat, and you will know exactly what you need to do to protect yourself before the window closes. Let's get into it. The price crash. What actually happened? First, let me quickly address the price action so we can move past it and focus on what actually matters. Silver dropped from $88 to $74 in a matter of days. Gold fell from $5,200 to $4,850. The usual suspects blamed it on rising dollar strength, profit-taking after the January rally, technical resistance at key levels, recession fears reducing industrial demand. All of these are partially true. None of them are the whole story. The whole story is the same story it's always been. Coordinated paper selling during low liquidity windows to trigger algorithmic stop losses and create maximum psychological impact. We've covered this extensively in previous videos. The Bloomberg Russia memo, the fake news spoofing, the CME margin hikes during rallies, the vault data showing massive physical deliveries happening simultaneously with paper price crashes. You know the playbook by now. They crash the paper price while draining physical metal. You panic and sell your position. They accumulate at a discount. That's not new. And it's not what you should be worried about. Because the price manipulation, as frustrating as it is, at least allows you to participate in the market. You can buy the dips. You can accumulate during crashes. You can position yourself for the eventual reversal. But what I'm about to show you is different. What I'm about to show you is a systematic effort to change the rules in ways that could lock you out of your own wealth without ever technically confiscating it. The three-tier system emerging. Pay very close attention to this section because most people have no idea this is happening. Across multiple jurisdictions, China, India, Western Europe, and potentially the United States, a three-tier system for precious metals ownership is quietly being constructed. Let me explain what I mean. Tier 1, institutional and government holdings. At the top of the pyramid are central banks, sovereign wealth funds, and approved institutional custodians. These entities have unrestricted access to precious metals. They can buy unlimited quantities. They can take physical delivery. They can move metal across borders. They can store in allocated form with full legal title. No restrictions, full liquidity, complete control. Tier 2, wealthy individuals with compliance infrastructure. The second tier is high net worth individuals who can afford the compliance costs of owning precious metals under increasingly burdensome regulatory frameworks. These are people who can hire lawyers to navigate complex ownership structures, pay for professional storage and approved facilities, file detailed tax and ownership disclosures, maintain relationships with banks that still service precious metals clients, document the source of funds for every purchase, comply with anti-money laundering requirements that are growing more onerous by the month. This tier can still own precious metals, but it's expensive, and it's getting more expensive. Tier 3, everyone else. And then there's the third tier, the retail stackers, the ordinary people trying to protect their wealth, the middle class who bought silver eagles and stored them in a safe. And this tier is being systematically pushed out of the market, not through confiscation, but through regulation, compliance costs, and infrastructure denial. Let me show you how this is happening in practice right now. India, the preview of what's coming. India is the canary in the coal mine. What's happening there right now is a preview of what could spread globally. In January 2026, Indian bullion dealers began defaulting on silver deliveries. We covered this in a previous video. People paid for silver and dealers couldn't deliver. But here's the part we didn't emphasize enough. The government's response was not to investigate the dealers, it was to increase restrictions on buyers. New regulations proposed in February 2026 include 1. Mandatory PAN card registration. Every precious metals purchase above a certain threshold, currently proposed at 50,000 rupees, roughly $600, must be registered with your permanent account number, India's tax ID. 2. Purchase limits. Individuals may face annual limits on how much gold and silver they can purchase without special approval. The proposed limit is reportedly 500 grams of gold and 2 kilograms of silver per year per person. 3. Digital tracking. All purchases must be made through approved dealers who report transactions to a central database managed by the tax authority. 4. Proof of income requirements. For purchases above certain thresholds, buyers must prove that their income justifies the purchase, effectively requiring you to demonstrate to the government that you deserve to own precious metals. Now, defenders of these regulations say they're about fighting money laundering and tax evasion, and maybe that's partially true, but here's the effect. It makes precious metals ownership expensive, complicated, and surveilled for ordinary people, while institutions face no such barriers. This is not confiscation. This is something more subtle, making precious metals legally available but practically inaccessible for most people. Europe, the KYC stranglehold. Meanwhile, in the European Union, a different mechanism is being deployed with the same effect. The EU's Anti-Money Laundering Directive, AMLD6, has progressively tightened the requirements for precious metals dealers. As of 2024, any cash purchase of precious metals above 10,000 euros is prohibited entirely. You must use traceable electronic payment methods. But more significantly, dealers must now conduct enhanced due diligence on anyone making purchases above 2,000 euros. What does enhanced due diligence mean in practice? Verification of identity, government ID, verification of address, utility bill, bank statement, source of funds documentation, purpose of purchase declaration, ongoing monitoring of customer behavior. For a 3,000 euro purchase of silver coins, a relatively modest stack, you're now subjected to the same level of scrutiny as someone opening a bank account or applying for a mortgage. And many dealers, facing the compliance costs and liability risks of maintaining this infrastructure, are simply choosing to stop serving retail clients below certain minimums. Require account relationships before allowing purchases. Exit the physical precious metals business entirely. The result? The number of places where ordinary Europeans can walk in and buy physical silver is shrinking rapidly. Again, this is not confiscation. The government isn't seizing your metal. They're just making it increasingly difficult, expensive, and surveilled to acquire it in the first place. United States, the infrastructure squeeze. In the United States, the mechanism is different, but the direction is the same. The IRS has long required Form 8300 for cash transactions above $10,000. But recent enforcement actions are going further. 1. Dealer reporting requirements. The IRS is increasingly aggressive in auditing precious metals dealers and demanding customer transaction records. Dealers who don't maintain meticulous records face severe penalties. 2. Bank de-risking. Major banks are increasingly unwilling to service precious metals dealers. JP Morgan, Bank of America, Wells Fargo, many of the largest banks have quietly exited relationships with bullion dealers, citing compliance risk. When dealers can't maintain bank accounts, they can't process electronic payments. When they can't process electronic payments, they're pushed into a cash-only model. When they operate cash-only, they're flagged as high risk by regulators. It's a squeeze play, and it's working. 3. Storage facility regulation. The SEC and FinCEN are expanding their definition of who counts as a money services business and a custodian under securities law. Private vault companies are facing pressure to register, comply with KYC requirements, and report customer holdings. Some vault companies are complying, others are exiting the business. The net effect? Fewer options for secure private storage outside the banking system. China, the zero lots rule. And then there's China, where the approach is most explicit. As we covered extensively in a recent video, China has implemented what's called the zero lots rule on the Shanghai Futures Exchange. If you don't have a government-approved hedging quota, meaning you're not an approved industrial user or financial institution, you receive zero allocation for physical delivery. You can trade the paper contract, you can speculate on price, but you cannot take delivery of actual metal. The government has effectively created two classes of market participants: approved entities who can access physical metal, everyone else who can only trade synthetic derivatives. This is the most naked expression of the three-tier system, and it's not a proposal, It's operational policy right now. The pattern: legal but inaccessible. Do you see the pattern forming across all these jurisdictions? Nowhere is the government saying, you cannot own precious metals. That would be too obvious. It would trigger backlash. It would create a black market. It would be politically difficult in countries that pride themselves on property rights and free markets. Instead, what they're doing is far more clever, making precious metals legal to own but progressively harder to acquire, more expensive to store, more surveilled to hold, and less liquid to sell. You can own silver. You just need to register with the government, prove your income justifies the purchase, use approved dealers who track every transaction, pay compliance costs that make small purchases uneconomical, store in facilities that report your holdings to authorities, accept that selling might trigger tax events, audits, and documentation requirements. It's legal. It's just not worth the hassle for most people. And that's exactly the point. The real end game. Now let me tell you what I think the end game is, and this is speculation based on current trends, so take it as such. I don't think the goal is confiscation. Confiscation is messy, politically dangerous, and creates martyrs. The goal is stratification. The goal is to create a world where governments and institutions hold massive amounts of physical precious metals to back currencies and provide stability during the next monetary reset. Wealthy individuals who can afford compliance infrastructure hold precious metals as part of diversified portfolios. Everyone else holds paper, digital dollars, CBDCs, government bonds, maybe some approved ETFs. When the monetary reset comes, and increasingly it looks like one is coming, the people holding physical metal will be protected. Their wealth will be preserved, maybe even multiplied. The people holding paper will be at the mercy of whatever the new system decides their paper is worth. And the mechanism for ensuring that ordinary people hold paper instead of metal is not confiscation. It's making metal legally available, but practically inaccessible. It's already happening. The infrastructure is being built. The regulations are being implemented. The compliance costs are being imposed. Most people aren't noticing because it's happening gradually, jurisdiction by jurisdiction, regulation by regulation. But stackers should be worried, because if you wait until the system is fully implemented before you acquire your position, you might find that the window is closed. What you should do right now. So what do you actually do with this information? Let me be very clear and very practical. 1. Acquire physical now, not later. If you've been waiting for the perfect entry price, stop waiting. The regulatory window is more important than the price window. Every month that passes, compliance requirements tighten. Every quarter, fewer dealers serve retail customers. Every year, the documentation requirements become more onerous. The difference between buying silver at $75 versus $65 is 15%. Annoying, but not catastrophic. The difference between being able to buy physical silver at all versus being locked into paper instruments only is infinite. 2. Diversify storage jurisdictions. Do not keep all your metal in one country, especially if that country is showing signs of implementing the tier system we've discussed. If you're American, consider storage in Singapore, Switzerland, or other jurisdictions with strong property rights and less aggressive regulatory trajectories. If you're European, consider storage outside the EU. If you're in India or China, the window for moving metal offshore may already be closing, but explore legal options while they exist. 3. Establish relationships with dealers now. As dealers exit the retail market or implement account-only sales, having an established relationship matters. Don't wait until you want to make a large purchase to start that relationship. Buy something small now. Establish yourself as a customer. Build trust. When compliance requirements get heavier, dealers will prioritize existing known customers over new, unknown ones. 4. Document everything. Keep meticulous records of every purchase, receipts, payment records, source of funds documentation, dates, and prices. You may need to prove to tax authorities years from now that you acquired metal legally and when. The burden of proof will be on you, not them. 5. Consider allocated storage over unallocated. If you're using professional storage, pay the extra cost for allocated storage where specific bars are assigned to you, segregated, and audited. Unallocated, pooled storage is cheaper, but it makes you an unsecured creditor in a bankruptcy, and it's the first type of holding that regulators can easily seize or freeze. 6. Understand the risks of ETFs. Silver ETFs are convenient and liquid. They're also paper. They're also regulated securities subject to government intervention. If you hold SLV or PSLV, understand that in a crisis scenario, there are mechanisms through which governments could freeze redemptions, force cash settlement instead of physical delivery, impose windfall taxes on gains, restrict who can hold the security. Physical in your possession or in allocated private storage is harder to touch. 7. Learn the legal limits in your jurisdiction. Know exactly what the current reporting thresholds are in your country. At what purchase amount must dealers report to tax authorities? What documentation is required for large purchases? Are there annual limits on how much you can acquire? What are the rules around cross-border transport of precious metals? Operate within the law, but operate with full knowledge of where the lines are. The uncomfortable truth. Here's the part that's going to upset some people. The silver squeeze you've been hoping for, the one where physical demand overwhelms paper supply and price goes vertical, might happen. But when it does, there's a very real possibility that you won't be able to participate. Not because you don't have money, not because you don't believe in the thesis, but because by the time the squeeze is obvious to everyone, the regulatory infrastructure will have made it prohibitively difficult for ordinary individuals to acquire physical metal. The squeeze will benefit Tier 1 and Tier 2, governments and institutions with unrestricted access, wealthy individuals with compliance infrastructure. Tier 3, retail stackers, will be stuck watching from the outside, holding paper proxies that may or may not deliver the returns that physical would have provided. That's what you should be worried about. Not the price crash, not the manipulation, not the volatility. The risk that by the time you're ready to act, the door will be closed. The window is still open. The good news, if there is good news in this analysis, is that the window is still open right now. You can still walk into a dealer and buy silver. You can still take delivery. You can still store privately. You can still move it across borders with proper declaration. The infrastructure for retail precious metals ownership still exists, but it's being dismantled, piece by piece, regulation by regulation. China's zero lots rule didn't happen overnight. It was the culmination of years of progressive tightening. India's KYC requirements didn't appear suddenly. They evolved over a decade. Europe's AMLD directives have been building for years. The US debanking of precious metals dealers has been a slow squeeze, not a sudden shutdown. The direction is clear. The pace is accelerating. The window is closing. And when it fully closes, the people on the inside, the people who acted while it was still easy, will be protected. The people on the outside will be holding paper wondering why the returns don't match the fundamentals. The final warning. Silver just got crushed, again. And while everyone is freaking out about the price, very few people are paying attention to the regulatory infrastructure being built around them. That's a mistake. The price will fluctuate. It always does. If the fundamentals are right, it will eventually go higher. But your ability to access physical metal might not always be there. That's what stackers should be worried about, not the crash. The infrastructure change happening quietly while you're distracted by the crash. Don't say you weren't warned. Drop a comment and tell me, is your jurisdiction already showing signs of the three-tier system? What regulations have you noticed being implemented? I read every single comment, and I genuinely want to know if you're seeing these patterns in your country. This is Asianguy, where the real threat is never the one making headlines.